Good morning for our viewers worldwide. I'm Manus Granny in Dubai. Ronnie Quinn alongside me in New York. You're welcome to Bloomberg Brief. Let's set that agenda.
Well, Fed speak galore, Manus. Governor Kugler calls for a balanced approach to rate cuts. The New York Fed's John Williams shows confidence in a soft landing. Heading to Washington, Israeli Defense Chief Yoav Gallant set to meet with U.S. Defense Secretary Lloyd Austin amid geopolitical uncertainties. And Hurricane Milton headed towards Florida as the state struggles to recover from Helene's devastation.
Well, these equity markets are struggling for a real clarity and direction, roiled by the flashing 4% on the bond yields yesterday. And again, that's unfinished business there. We're ticking slightly higher. The 4-week winning streak was broken yesterday, down by over 1%. What is a soft landing? What is a no landing? We'll ask that question to our guest in just a moment. Of course, Goldman's want you to pick up any dip. They see 6,000 in 3 months, as we saw. But we'll talk about Fed Williams' call for a soft landing. Don't get used to 50 basis point cuts. Let's have a look at the bonds. 4 days of losses. We're still back above 4% on the 10-year government bond yields this week. There's $119 billion worth of bonds to be issued, $58 billion worth at the short end today in threes. And Williams guides 50 basis point cut. The rule of how we act in the future, don't get used to it. That is the bottom line. Today, you're going to see short end paper come to the market, $58 billion. And as we heard from State Street yesterday, the short end will be absorbed quite easily. It's the 10-year paper, Vonnie, that we want to worry about a little bit later in the week. Good morning.
Good morning, Manus. And yes, I think it is a market that may not be struggling for direction, but it's definitely that market participants are choosing a direction right now, right? So after the jobs report, we had the S&P up almost 1%. Now we're looking at a second day of decline. So it really is a question, are you trading the growth trade? And does that look better now after that one jobs report? Or are you trading the easing trade? And what should you be doing in that case? So it really is a question for all of our guests. Literally yesterday, we had guests on saying, you know, 100 basis points too high still, or 100 basis points too low. And Citi is looking for 50 basis points of a cut in December still. So Fed officials beating their... Fed officials, Manus, beating their own drums. John Williams, Alberto Musalem and Adriana Kugler having different approaches to future rate cuts, just like those market participants. Joining us now is Jennifer McKeown, Chief Global Economist at Capital Economics. So, Jennifer, what do you do in a situation like that? Do you take 1 month's jobs report and say, OK, the economy is doing fine, we may need a recession to actually get inflation down? Or do you decide, well, no, we need the Fed to continue easing?
Yeah, well, I think you certainly don't take 1 month's jobs report and draw a great deal from that. And actually, we were saying the same back in the summer when we had that awful jobs report and there were real hard landing fears picking up again. These data can be quite volatile. You don't want to take too much from one really great month. Actually, if we look at surveys of hiring intentions across the US, things like job quits rate, hours worked, the number of temporary workers that are being hired, all of those things still tell a story of a softening labour market. So I think really that's what the Fed's going to be looking at. And I think it still really points to this kind of soft landing scenario that they'd most like to see. And that is consistent with continued rate cuts because interest rates are still high, still restrictive, but gradual ones. I don't think we're looking for further 50 basis point cuts at this point.
Jennifer, good morning to you. It's interesting how we're trying to qualify what soft landing and no landing is or what morphs from one to the other. CPI data is due later this week. Can the inflation data trump the jobs data from last week, since we were told it's on the back burner?
Yeah, well, we're anticipating a further slight softening in headline inflation to about 2.3%. The Fed will be happy to see that. Core inflation, though, still likely to be a bit too strong at around about 3.2. So some concerns there that inflation is proving a bit sticky. But if we look at again, most of the forward-looking indicators of inflation in the US and the monthly rates of inflation, which tend to be what markets will focus on these days, it's pretty clear that inflation is heading back into line with targets. So again, that's consistent with this soft landing scenario, and the Fed will be happy to see it. More worrying is the upward revision recently that we've seen to labour incomes and labour compensation suggests that wage growth may be a little bit stickier than the Fed would have hoped. But again, given the signs of softening in the labour market, it will be hopeful that we'll see this gradual deceleration continue.
Jennifer, just bear with us a moment. I want to point to Honeywell, which is up 1.75% now in pre-market trading. The Wall Street Journal is reporting that Honeywell materials business may be being spin off, and that particular business may be worth over $10 billion. Once again, Honeywell expecting to spin off its advanced materials unit. This is according to the Wall Street Journal, which would support Honeywell Chief Executive Vimal Kapur's plan to simplify the company business. And we're seeing quite a lot of this now. But for Honeywell, it would be core segments of aviation, automation and the energy transition. So we'll keep an eye on Honeywell throughout the morning. But Jennifer, back to economics and the economic environment. Is there any call for any house to be still looking for a 50 basis point cut between now and the end of the year?
I'm surprised that anybody is really given that payrolls report. Although I said let's not take too much from 1 month's data, I think it pretty clearly does add to the soft landing kind of scenario, which is apparent in a lot of the other US data too, including things like retail sales, bank lending. It all suggests that the economy is still growing at a fairly healthy pace. I guess if you were looking for reasons to cut more aggressively, it would be the fact that interest rates are still high. The level is still high, so you might want to normalise more quickly, or that you're looking at forward-looking indicators like delinquency rates on auto loans. Things like that suggest that maybe some consumers at lower ends of the income spectrum are feeling the pinch from this high level of interest rates.
Yeah, and we're going to get a little bit more information on how the consumer is over Amazon Prime Day over the next 2 days. Jennifer, your take on the disinversion and reflattening of the curve. I mean, it is shape-shifting. We angst over the disinversion, and now we seem to be reconsidering what happens when we went back to flat. What's more malevolent, disinversion or reinversion?
I'm not sure. It's unusual, actually, for this to happen, for you to get the sort of the inversion and the disinversion and the reinversion again. I think what it shows really is that markets are struggling a little bit for direction. We're at a little bit of a turning point, looking to see what's happening with the Fed and the pace of those cuts going forwards. I wouldn't really read too much into this. I'm much more concerned about what's happening in the labour market, what's happening in the inflation data as a guide to where actually terminal rates will be and to whether or not the US is going to experience a hard landing. There are lots of recession indicators out there, and I don't think that inversion, reinversion, disinversion are particularly good ones as indicators of recession.
Jennifer, we've had at least a 50 basis point cut now, so we know that that's in the books, right? That's very unlikely to get reversed at any point soon. But we also know there's an election coming up, and there's the possibility of, a Trump presidency or a Kamala Harris presidency at the same time as that transmission mechanism is working itself out. How do you factor in both things at the same time into the US economy?
Yeah, it's extremely difficult and clearly adds to the uncertainty for the Fed going forwards and for all of us about just what US policy is going to look like. I think Kamala Harris, that's probably more or less a continuation of the status quo. Might not be great for equity markets given some of the antitrust type measures that she might implement. Also, her calls for higher capital gains tax, those kinds of things might weigh on equities, but I don't think a big impact on the economy more generally speaking, or on the Fed. Trump is another kettle of fish, obviously. I think most of the policies that he's talked about would be relatively stagflationary, so bad for growth and likely to push up inflation, including the tariffs and his immigration policies too. So I think there's a possibility. Of course, we don't know what exactly which policies he would push through and the extent to which he would be able to push them through were he elected. But if the things that he's talking about come to pass, then I think that might mean a slower pace of Fed loosening, or maybe even an end to Fed loosening if they are to push up inflation really significantly.
Yeah, well, Bloomberg's run the numbers, and we look at the worst case scenario with China tariffs at 60%. It would wipe nearly 1% off the growth and push prices up by over 4% through 2028. So again, it brings that inflation narrative up. Jen, thank you very much. Jennifer McKeown of Capital Economics this morning on the Outlook. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. Maersk says it will drop a surcharge for handling goods at US ports, planned later this month. The charge in the plan comes after dock workers along the US's east and Gulf coasts suspended a strike after agreeing a tentative wage deal with the container shipping industry. Now, the surcharge was announced last month.
Retaliation from China. The country is studying tariffs on large engine vehicles and has slapped a levy up to 39% on European brandy. The protectionism comes after the EU decided to impose tariffs as high as 45% on imports of Chinese electric vehicles for 5 years. The document from China's Ministry of Commerce specifically mentions spirit makers controlled by Rémy Cointreau and Pernod Ricard.
And Samsung issued a rare apology to investors for facing a crisis after disclosing worse than projected profit and revenue. The memory chip giant used to dominance but has fallen behind its Korean rival SK Hynix in recent years due to the delays in delivering AI memory chips. There they are again. The company's newly appointed head of core semiconductor business promised to overhaul the organization.
Well, coming up here on Bloomberg Brief, Israel's defense minister headed to Washington to meet his counterpart as attacks continue in the Middle East.
And later in the hour, we speak to Keith Lerner of Truist for his outlook on the markets. Context matters from Bloomberg. This is Bloomberg Brief. I'm Manus Cranny in Dubai, Vonnie Quinn in New York. The Defense Minister Yoav Gallant is set to arrive in Washington on Wednesday to meet with the US Defense Secretary Lloyd Austin as Israel weighs its response to Iran's missile attack. Bloomberg's Jumana Busechi joins us now. Jumana, this touchdown by the foreign minister, there's a very interesting piece from Carnegie. They talk about whether this is about coordinating or convincing the US about Israel's next step on Iran. What's the take?
Yeah, so the Defense Minister Yoav Gallant will be meeting with Lloyd Austin tomorrow at some point during the day. And many people are interpreting this as a sign that perhaps Israel's response to Iran may be delayed simply because there is going to be further coordination with the U.S. Discussions will be had about the scale of the operation. You'd have to think, given it will likely be an elaborate operation, the help of the U.S. in some shape or form, even if it's just operational, is necessary for them to enact the reprisal. Interestingly enough as well, it's noted that on Sunday evening, for a brief amount of time, just a couple of hours, the flights over Iranian airspace was completely stopped, but now air flights have resumed again, which signal that perhaps, again, there is an expectation that this reprisal is perhaps going to come later on during the week and not imminently. But in terms of what we're hearing, interesting to note that the defense minister himself in an interview said all options were on the table. Opposition leader from Israel said that they would be open to attacking Iranian oil infrastructure. And we know also from comments that President Biden delivered last week that they are against Israel directly targeting nuclear infrastructure or even oil infrastructure because of the potential for this blowing up into a wider scale conflict. And of course, the impact it could have on oil prices as well. On Iran's side, we also had comments from the Iranian foreign minister this morning saying enemies know what Israeli infrastructure is in our reach. Any attack on Iran is to be met with more powerful response. So more rhetoric coming from Iran.
So, Jumana, that's sort of the high-level talks, right? What is actually happening on the ground in the various different countries?
Yes, well, yesterday we were talking about the marking of October 7, and many commemorative ceremonies were held around the world, from Beijing to Berlin to the US. President Biden had a ceremony to mark the event as well, in honor and commemoration of those whose lives were lost. But equally on the ground, as we were reporting yesterday, the conflict is still very much present and intensifying. Yesterday, throughout the course of the day, Hamas fired rockets into Tel Aviv. Most of them were intercepted. Equally, IDF say about 135 rockets were fired from Hezbollah into northern Israel, into Haifa. Most of them also intercepted as well. And this morning, the IDF are saying that they're adding another division to the ground operations that are taking place in the southwestern part of the country. They've also warned Lebanese citizens in the southern part of Lebanon to stay clear of the coast because of imminent participation by the Israeli Navy as well. And so what's very clear here is, even though Israel has said that these are limited ground raids, the war or the conflict in that part of the region clearly seems to be expanding and moving further north away from the border.
Jumana, thank you so much. That is Jumana Bersechi, anchor of Bloomberg Horizons, out of Dubai for us there. And I do want to check on crude oil because we're seeing it come off just a little bit. Brent is below $80 a barrel, 79.21. WTI in New York, though, 75.44, down about 2.2%, but still above that $75 mark. Of course, the China story is playing in a little bit here as well, with a little bit of disappointment overnight out of the first session post-Golden Week. Manas.
Yeah, crude's certainly not getting the love that the Chinese equities had at one stage. So we are just seeing a drop there. Coming up in this show, a look at what else is making the headlines from around the world. We'll take you through the front pages. Also update you on the latest on the hurricane bearing down on Florida. Context matters on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York, along with Manas Cranny in Dubai. Time now for our front page news, a look at what's making headlines around the world. And we'll start with the Washington Post, which is leading with Tampa Bay braces for what could be the strongest storm in a century. Evacuation orders issued across Florida. Manas, the storm expected to make landfall late this evening or perhaps early Thursday. Tampa, which hasn't seen something like this in more than 100 years, could find itself in the most dangerous part of the hurricane, depending on the hurricane's exact path.
Bonnie, let's bring our viewers some shots of the next big issue, of course, in Milton. There. Next up, Financial Times. Kamala Harris rules out bilateral talks with Vladimir Putin on ending the war in Ukraine. Harris wants leaders from Kyiv involved in any negotiations. The vice president spoke in an interview with 60 Minutes.
Fascinating, yeah. And then just to finish with a Bloomberg story, which we've been hinting at, China vows to hit economic goals but stops short of large stimulus. Investors clearly disappointed in the lack of any more fuel out of the policy meeting, which has been a world stock rally over the last 3 weeks after officials from the NDRC largely reiterated plans to boost investment and increase support. Let's get more now on this story. We have Bloomberg's Asia Economics and Government reporter Rebecca Chung-Wilkins. So, Rebecca, we've had this amazing rally. It looks like we might open in the US today with some of those ETFs that track the offshore stocks lower by maybe 10%. I'm talking about FXI and KWeb, for example. But yet there has been this stunning rally, and you couldn't really anticipate more last night from the NRDC. Walk us through the market reaction and how to make sense of it.
Yeah, absolutely. I think there was an extent to which markets probably had slightly unrealistic expectations from what we typically see from China's top economic planner. They don't have a mandate to actually announce new stimulus, but somehow that is what investors were hoping to see, some kind of fiscal stimulus. So stocks and commodities both disappointed in reaction to that. So onshore stocks, for example, that have been on holiday through the so-called Golden Week holidays through the past week, they climbed out the gates. They hit nearly 11%, but by the time we got halfway through that briefing, they'd already paired, about half of those gains. So still 10 days of gains for that onshore stock index, but definitely a kind of recalibration when we didn't see any new news coming from the briefing. Stocks in Hong Kong also taking something of a sort of recalibration. The worst day, in fact, for Hong Kong stocks since the global financial crisis. But again, it was because we had this incredible rally. It was really coming off the back of this sort of roaring trade that we have seen. We now see Chinese counterparts, the offshore Chinese counterparts, trading about at the same level as they were prior to those holidays. Now, in the commodity space, again, Brent, for example, Brent oil coming down beyond lower than $80 a barrel, and commodities generally kind of fairly disappointed with what we saw from the briefing today. Worth flagging, we may have a Ministry of Finance briefing in the coming days or weeks, and that is where we would potentially see any kind of fiscal stimulus actually announced.
OK, Rebecca, thank you so much. It is all about the quality of that stimulus. Let's see what they bring. Rebecca Chung-Wilkins. Let's just take a quick snapshot of what's going on with Honeywell. Vonnie brought this to you a little bit earlier. The story is in the journal. The plan is maybe to sell off or to spin off their advanced materials division. That's worth about $10 billion. Market cap of the stock is about $130 billion. Look at the stock bid, up by 2.78%, so a $10 billion sell-off. We'll ask our next guest a little bit about what's going on in corporate America industrials in just a moment on Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Vonnie Quinn, along with Manus Cranny in Dubai. Let's set your agenda.
Fed Speaker Governor Kugler calls for a balanced approach to rate cuts. The New York Fed's John Williams shows confidence in the soft landing. Tax the rich, VP in her latest sit-down interview with 60 Minutes. And Hurricane Milton heading toward Florida as the state struggles to recover from Helene's devastation.
Let's get a quick check on these markets now. We are early trading. It is 4 hours to go till the market opens, so these could change. But for right now, we are looking at potentially a reversal of yesterday's decline. It does seem to be a market that's looking for a little bit of direction, or at least maybe, committees are meeting and deciding what to do after that jobs report on Friday, post the 50 basis points Fed reduction as well. And really, how many Fed cuts are we going to have by the end of the year, if any at all? The S&P is showing a gain of perhaps 0.4% at the open, which again, bear in mind, is 4 hours away. The two-year yield, we're back down to 3.96. It seems funny to say, right? We're only at 3.68 or so just a week or so ago, so that is still an almost 30 basis point move, but we have given up a couple of those basis points. Crude is coming off as well, but we are still above $75 a barrel in New York. I don't want to underplay this too much. Geopolitical tensions still very much alive and well. And one more thing, the VIX still elevated above 22, down very slightly from yesterday's session. And of course, we have to bear in mind that there was a lot of movement for stocks in the Asia session. Hong Kong stocks dropping precipitously, and that'll have an impact on some of the ETFs later on in the US trade. But mainland China stocks continued with their rise, though perhaps not as ebullient as people might have hoped for, Manus.
Yeah, Vonnie, definitely a brutal day for the Hong Kong stocks there, down the most since 2008. Look, on the bond market, obviously, we're grappling with the 4% on the 10-year paper. It's still above that, as we see, carrying through from yesterday. We've got $119 billion worth of bond paper to hit the market. 3-year paper today, $58 billion, and then we roll into the 10s, and that's where you're going to maybe struggle to chew down on that. But Williams makes it clear on the 50 basis point cut narrative, the rule of how we act in the future, don't get used to it. Don't get used to 50 basis points. Vonnie.
Whatever you say, Manus, although I'm not sure. Turning to tech now, Alphabet facing a revenue hit to its app store. A federal judge ruling that the company must lift restrictions that prevent developers from setting up rival marketplaces to compete with its Google Play app. Joining us now is Bloomberg's Tom McKenzie. So, Tom, give us the details. What did the judge rule?
Yeah, Vonnie, this is a federal judge in San Francisco, and this is coming through with the remedy. They were found earlier this year, Alphabet, to have been running a monopoly when it comes to the Google Play Store by monopolizing the payment systems and the ability for rivals and competitors to build out their own app stores. The judge ruling in this case, this was Epic Games, the maker of Fortnite, versus Alphabet, ruling that they have to essentially make these significant changes right now, Alphabet, around the Play Store, the Google Play Store, to ensure that those things change, that their competitors can build out other app stores and that Google and Alphabet don't dominate the payment system, that you can have competitive and other alternatives in terms of payments. So both on the apps front, on the App Store front and the payments front. It's a really significant ruling for Alphabet. It's facing a number of challenges, of course, in terms of these anti-monopolistic rulings coming through from the DOJ and in this case, Epic Games. And it could have a pretty material impact as well on profits for the company going forward.
Yeah, I mean, the numbers, if you look at it, Tom, you're looking at, maybe $1 billion off gross sales over the next couple of years. We want to shift it on. We've got Amazon Prime Day. When Vonnie walked in this morning, she was on that site. She was laser focused on what's going on with what's going on with Amazon. Look, it is Amazon Prime Day. I suppose the question here is, what's it going to look like for them, Tom? And are we going to understand more about the consumer?
Well, look, this is key, isn't it? When we talk about the labour market of the US, when we talk about how markets are repricing, you were talking about that 4% level, of course, on US 10s. How strong is the US consumer as you lead up? Of course, there's the electoral and political element as well. Is the consumer still firing on all cylinders? You had the unemployment rate dropping to 4.1%, wages are up. Is the consumer still there? Amazon Prime, that event will give a touch point and a taster of that, of course. That's the significance. More broadly for the story around Amazon, it's really about AWS, the spend, of course, a hyperscaler in terms of the data centers and the AI story in terms of future revenues for the business. But for the here and now, a gauge on the health of the US consumer.
Tom, thank you. And Amazon in early trading is up just about 0.5%. That is Bloomberg's Tom McKenzie there in London. Well, staying with tech, as Manus was saying, today kicks off Amazon Prime Day. He caught me. I was one of the shoppers looking for the best steals and deals at the e-commerce site. This has pulled holiday spending forward from November when Black Friday deals traditionally took place. Joining us now is Bloomberg's Dasha Afanasieva. How important is this Prime Day, Dasha, given that we know now sort of this is not the only day where you see stuff on sale on Amazon?
That's right. I mean, they already had one in July, that it was its 10th ever. The company said it's our biggest ever event, lots of discounts. But this is this new way that companies are loving squeezing us into more spending by saying this is just these days that you have the discount. And it really speaks to this bargain hunting environment. Consumers are fed up of high interest rates. They're still sort of reeling from that really high inflation we had last year. And where possible, even if they have the money, they're deferring spending. And that's why we've seen this turf war between more discount retailers, cheaper retailers like Walmart and Target, competing on price, competing on offering bargains. So this perception of bargains is very, very important. But of course, we all know that these days you actually have to do quite a lot of research to figure out if you're actually getting a good deal. And I, for one, can never see anything I want to buy on those special days.
No, you just got to click the button really, really quickly. I think it depends what you're looking for. We've also had, Dasha, a downgrade come through on Amazon, and this is from Wells Fargo. And it is really quite an awakening moment because it is around the future of cloud, and that is what we've been banking on a great deal, the AI, the cloud, and that side of the business.
Yeah, I mean, as Tom touched upon, AWS is very much what all of the market is watching because it's fast growing. It's sort of 3 times as profitable as the retail bit, and that's what everyone's excited about. In particular, this idea that AI investments will generate all these gains. Bloomberg Intelligence estimates a 20% revenue growth off the back of these investments. So in some ways, this analyst is being a contrarian. But still, retail continues to be the vast majority of the revenue. And if you like, it's kind of how Amazon gets into our homes, gets its tentacles into everyday aspects of everyday life. So you can't over-focus on that cloud aspect.
No, well, certainly there's been a shift from them. They're one of the few to tack back against Amazon. Dasha, thank you very much. Dasha Afanasieva on the Amazon story and the downgrade. Let's stick with the consumer. Let's have a look at this. Borrowing increase in August, pretty much at a slower pace than the month earlier, restrained by the largest drop in credit card balances since March 2021. Do we need to worry about the US consumer? Keith Lerner, Co-CIO at Truist, is with us. Keith, look, consumer discretionary is 10% of the SPOOs. You're neutral on it. When you look at that kind of rolling over on the credit side of things, is that a mini red flag?
Well, first, hey, very good morning to both of you. You know, I think the consumer overall is still relatively sound. It's definitely divergent. But in general, the other thing that we just saw over the last month is we saw consumer savings actually revised high in those benchmark revisions. And the key is jobs. So we had a good job number. I don't want to overstate one number on Friday because you have to look at the trend overall. But right now we have wages that are now growing above inflation. So again, they're cooling from where they've been, but overall, I think, you know, relatively still healthy. And going back to the divergence, man, this is, you know, one consumer has the stock market at all-time highs. We have housing prices that are lifted in 3% mortgages, and other folks are still dealing with, you know, low wages and inflation that's cooling but still elevated from a few years ago.
So, Keith, what would you do at this point? Would you start a rotation into some other areas, or would you wait for another little bit to see how the dust all settles?
Well, in our sector strategy, you know, one area that we still like a lot is tech. We actually upgraded the sector in early August on the downgrade, and I think there's been a lot of rotation, a lot of other stocks participating. The market's been broadening, and the AI story and tech has been pushed to the side. I think as we get into a bit more of a choppy environment here near term into the election, I think investors will rotate back into tech. We're seeing a little bit better activity over the last week or so from semiconductors. And the one thing that we really look at is the forward earnings momentum. It's still strongest in tech. So I think this bull market is the AI bull market. And if we believe the bull market is intact, which we believe, we think tech should still do well. On discretionary, that sector is a very diverse sector as well. You know, Tesla and Amazon are the two biggest stocks, but then you look at things like home builders and the Home Depots and the Lowe's of the world, those are doing actually really well. So I think it's more selective within the consumer discretionary sector specifically.
It's interesting. You say you prefer less rate cuts, stronger economy, which makes perfectly good sense. But how much can you tolerate? Some people are saying no more rate cuts for the rest of this year and a much more trimmed neutral rate. So what's your tolerance level for less rate cuts?
Yeah, it's a good question. No, it's interesting. Like the last couple of months, we go from like we're going into a recession, we're going into a reacceleration. We have more Fed cuts. We have less Fed cuts. It's like the market's moving left and right. And the only thing that's really been consistent in this market is corporate profits. So our preference is still for a stronger economy. You know, I still think the Fed likely cuts 1 or 2 times by a quarter point this year because the inflation numbers have still cooperated. I think, you know, the CPI number later this week is going to be important. So I think, Manus, I think for yields, I mean, more to your question, you start getting above 4.25 in the 10-year. I think that will be more problematic for the overall market. But right now, it's just injecting some volatility with this shift. But we have to remember, we're up 10 of the last 11 months. October tends to be a choppier month into the election. But here's the good news. In the fourth quarter, in election years where you've been up more than 10% heading into the fourth quarter, you've finished higher every single time. But again, I expect some of this, you know, some of these hiccups along the way, which is natural.
Keith, you upgraded your view of emerging markets 1 notch this month. I'm curious as to how the stimulus out of China has played into this view and whether after the first session back post-Golden Week, you might be getting a little bit more nervous about China again.
Yeah, well, so overall, you know, we downgraded emerging markets to least attractive in our rankings back in May of 2021. So it's underperformed the S&P by about 50% since that time. We moved it up 1 notch, but it's still below neutral. Listen, I think context, though, is important here. The markets, you mentioned some of the ETFs, some of the internet ETFs, up 40 or 50% in 2 weeks. So you're not going to have a normal 2 or 3% pullback along the way. You're going to see something that's more dramatic, and the expectations got high. You know, I still expect that China's not going to let this market just roll over. I mean, yes, you're going to have a pullback to some hot money, but I think they'll be committed to supporting this market. So I think we actually, this rally, even though it's, hit here near term, likely has a bit more to go. But I think the longer term challenge for China and why we haven't moved, to neutral or above is that the policy is erratic, right? And that's what we're seeing already. And I don't know if that changes longer term. But again, I expect that you'll see maybe some better news or some of the government officials start to talk over the next week or two if we see some continued weakness.
Keith, to what extent, I mean, you've got a brilliant quote, two old adages for Wall Street, on Wall Street, don't fight the trend and don't fight the Federal Reserve, and they remain the two key pillars for today's equity market. But the one thing that the equity market, up 20% in the year, was hoping for was a flush of money from the money market funds into equity and bonds. A lot of people said maybe the bonds would win, but if we've got a delayed Fed, does the rally stall with that flow?
Well, I think it maybe stalls on a short-term basis, but I think it's going to be, don't forget, this week we're going to start talking about fundamentals again. We have the earnings really kicking off with the financials on Friday and then into the rest of it. And I think the biggest story, going back to our favorable view of technology, that's over 30% of the overall index. So I think it'll be more important to see if tech profits come through overall. And going back to the adage, I mean, at this point, I think you have to give the bull market the benefit of the doubt, right? The underlying trend is positive. We know we're moving into a seasonally positive fourth quarter, even though October tends to be trickier. We have, the Fed still easing. I think, listen, the other thing that's good is if the economy does start to slow down again, guess who's going to come back? The Fed. They're going to be more aggressive. So I think that's something to think about. We have the ECB also cutting rates, and China will provide more stimulus. So I think at this point, you still want to stick with that primary trend, which we think is up. But again, some hiccups along the way.
All right, Keith, thank you so much. Great conversation there with Keith Lerner of Truist. Coming up, Vice President Harris bashes on her opponent for, quote, political gamesmanship as storms continue to ravage the southeastern coast. More on that next. Context matters on Bloomberg.
I'm going to make sure that the richest among us who can afford it pay their fair share in taxes. It is not right that teachers and nurses and firefighters are paying a higher tax rate than billionaires and the biggest corporations.
That was Democratic presidential candidate and Vice President Kamala Harris speaking to CBS. Both candidates have also been spending time sitting down with podcasters while on the campaign trail in an effort to reach voters who've turned and maybe tuned out of conventional political news flow. Here to bring us the latest on the race for the White House is Bloomberg senior Washington correspondent Saleha Mohsen. So, Saleha, what are we learning from the candidates' engagements and interviews and fora and where they're deciding to have these?
Yeah, we're seeing them join a lot of podcasts, actually, which shows the kind of influence that industry has now on voters and the American electorate. You have a lot of people who are sophisticated absorbers of news and politics who maybe aren't reading the headlines coming out of Washington every single day, but they have a trusted podcast host and they're open-minded to a actual policy discussion, not like a quick hit TV interview where someone's constantly giving spin, but a host that they trust and have listened to for maybe years, and hear from the candidates themselves directly answering questions, not from a news anchor. It's not, quote, the media. And they're finally getting to hear some of the questions answered that they've had on their minds.
Look, one of the biggest issues is dealing with the hurricane from a couple of weeks ago. Storm Milton is set to hit Tampa in Florida over the next couple of days. Again, we're really trying to understand what impact this is going to have maybe on early voting. We've got North Carolina, we've got various states really coming to the rescue in terms of this process and trying to make sure that voting is not interrupted or at least goes as normal as is possible.
Yeah, early voting is always a delicate situation. Rain, weather really matters. And all of a sudden we have extreme weather events hitting key states, Georgia and North Carolina. Families have had to evacuate. The last thing they're trying to figure out is how to get their early ballot, whether it's arriving in the mail or by email or where their precinct is. Local precinct captains are also having to figure this out. We are seeing that, the 2020 trend of voters wanting to vote early or do mail-in voting, that was sort of a COVID-related trend. It has continued. Now, in the 2020 election, twice as many Democrats did early or mail-in voting compared to Republicans. And this time, Republicans are, in some key states, really stepping up their game, trying to encourage Republicans to take advantage of that.
And Saleha, obviously it's going to be challenging in some of the storm-ravaged counties and states, but early voting has been underway in many states. Can you give us the latest on those ballots?
It's hard to know. So in Pennsylvania, if I give you that example, Republicans have spent $10 million trying to encourage and enroll voters and get them to vote early. But so far, the early ballots are showing that it's mostly Democrats who have taken up and continued the 2020 trend.
Yeah, I'm just looking here at the New York Times. If we look at 2020, 24% of the overall U.S. went for early voting. But when it comes to the swing states, and particularly in North Carolina and Georgia, I'm just looking here, 9 out of the 10 voting sites have had significant damage or accessibility issues. But we are seeing really strong efforts being made by the courts to rectify this. If this next storm, Milton, isn't as severe or perhaps gets downgraded, that's going to be a relief for everybody.
Absolutely, it's going to be a relief. But I don't know if you've seen the latest polling figures from New York Times Siena. It shows that just in the state of Florida, where they are dealing with extreme weather, Trump is ahead by more than 10 percentage points. I think it's something around 44 percentage points compared to Kamala Harris. So it is going to impact how people view these candidates and what they do in their early voting moment.
OK, well, that has started, so we'll keep an eye on that and track it. Our senior Washington correspondent, Saleha Mohsin, with the very latest on the campaign trail. You can dive deeper into fully comprehensive analysis, all the facets of the campaign. Type in ELEC and hit go on your Bloomberg terminal. Coming up, Vonnie and I'll take you through what you need to know for the rest of your trading day. We've got some Fed speak. We have, of course, the conversation on Bloomberg. Jamie Dimon sits down with Lisa Abramovich on Bloomberg. Context matters. Good morning.